And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, my God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. Hi, I'm Phil Grande. Well, isn't it interesting? Today we finally had a true rotation. The last few days, not a real true rotation. It was like watching paint dry. But now markets have maybe a new direction. So what caused that? What the hell happened at noon? Because from opening to midday, again, nothing. It was boring, like watching paint dry. And all of a sudden, bam, everything started to explode. Tech started to get crushed. Defensive, everybody was running to defensive stocks, hiding. What happened? Well, first, before I talk about what happened, we're going to go through that. Most people always, what's the market going to do? What's the market going to do? Which direction it's going to go? It's not difficult to identify. Now, Wall Street's not going to tell you how to identify it, but I'm going to tell you right now. You always know the direction of the market. You always know. Okay? Because again, all you have to do is think of yields as a street light. So think of the street light at 4.48. Now, if the street light changes and goes up to 4.5, then we're screwed, because that's the danger area. That's when everybody starts dumping tech and they start going into, defensive, staples, utilities, healthcare, all those kind of stocks. So it's always the question, big question, what's the market going to do? You can identify what it's going to do just as well as pros by following, again, think of the 10-year yield as a street light, and when it climbs up to 450, you know exactly what's going to happen. The market's going to tank. And when it drops down to 4.25, the market's going to rally. Always works. And also today, everybody's running around their hair on fire, but nobody's talking about IWM. Everybody's ignoring the small, mid-cap stocks. That's the most dangerous thing you can do. It's the worst thing you can do, because IWM is a big deal. Those are the small, mid-cap stocks. Those are the economy. That's what you got to watch. And you don't hear anyone on these jibber-jabbers on TV talk about, boy, look at IWM, we really better watch that, we're in trouble. Because again, they are the most sensitive stocks, IWM, small mid-cap stocks, to rising yields. Why? Because small mid-cap stocks, those are small businesses. All the little banks, they take care of all the small businesses around this country. Not the big publicly traded. I'm talking about when you go down to your town and the main street, you got small businesses. And that's the strength behind our whole economy is small businesses. You take small business away, you haven't got anything. Everybody thinks it's GE and Tesla. No, it's a small business. So IWM is small business, sensitive to these kind of yields that are going up. And small caps hate these yields that are going up. Borrowing cost goes up. Refinancing cost goes up. Everything associated with financing with small business, credit tightens, lines of credit you can't get anymore. They raise rates. And let me tell you why IWM is so important. That's why they don't talk about it. They hide from IWM. They don't want you to know about IWM because it's the market's truth serum. Why would you need Wall Street if you know how to read the IWM? Now, IWM has predicted, get this now, every crash. Just take the last 25 years. It predicted right to the T, 1972, 2000 crash, 2008, 2013, 2022. Never misses. That's how important IWM is, and that's why you don't hear any of these jibber jabbers today talking about IWM. They don't want you to know that. Every crash is predicted. So, and also you know that when IWM is flat and the S&P and the Q are up, it's a fake rally. That's how you know rallies are fake, by looking at IWM. So they'll say, oh, S&P making a new high, the Q is making a new high. You know, they don't say anything about IWM. They don't want you to know about it, because if you look at IWM and IWM is flat, that's telling you the rally's fake. Wall Street doesn't want you to know a rally's fake, because after all, they buy the stocks first, mark them up to you, the retail investor, and then sell them to you. So they're not going to tell you. Now, the small mid-cap stocks, they roll over months before the indices roll over. They're the first ones to roll over. They're the truth serum. They're telling you, hey, we got a problem. This market's going to correct or crash. Never been wrong. And IWM is always the first casualty of Fed policies. Now remember, the Fed has never done anything well. The Fed's never been correct. The Fed has always been wrong. And IWM is they're like the canary in the coal mine. When the Fed has a bad policy or makes a mistake, IWM's the first to get hit. That's why IWM's so important. Nobody talks about it. Now, when IWM is strong, the economy's strong. When IWM is weak, the economy's weak. Put on your parachute. Always watch IWM. Leave that right on your chart. You never have to ask again, what do you think the market's going to do? And again, if you look at the 10-year Treasury yield, like a street light, when it turns at 4.50, that's trouble. Tech is going to collapse. Remember, there's 6 to 12 tech stocks. Actually, there's 6 tech stocks holding up this entire stock market of 700 stocks that we trade actively around the world. There's 700 stocks that are actively traded every day, and there's about 6 of those. I'll use 12 of those stocks that are holding up all 700. What are you, nuts? So IWM is when it's strong, the economy's strong. When it's weak, the economy's weak. It'll always tell you when the market's going to correct or crash. All right, so let's get to what happened today. What the hell happened during midday? After all, yesterday, the rotation, barely a rotation, it was like watching paint dry. We get out of the gate this morning, same thing, all morning, like watching paint dry. Then, bam, whoa, all of a sudden we see that 10-year yield go up, we see IWM go down. What happened? Well, first of all, I'm going to take a look for a second. Let me just put up here. I just want to see something. I'm sorry. I'll put it up here for you. Let's see if I can get this. All right. All right. Let's see if we can pop this up for you so you can see what's going on here. Hope I can get it for you. Yeah. If you look over here on my if you look at my Pro 3 chart right here, you see how this morning it opened up IWM right here, opened up right in here, right in this area right here, and now it's collapsed. Look at that. That's what happened, and so that's serious. So what happened this morning at midday? Well, again, the Fed chair, our new chair, Warsh, he comes out. He didn't say a thing. Okay, he didn't say a thing that would take the NASDAQ, or let's take the NASDAQ 100. I think we're down 620 points right now on the NASDAQ. And that's the big boy. Everybody's in the NASDAQ 100. Let me know what we're down. 600 points on NASDAQ 100. Check that for me. The NASDAQ 100? No, that's the NASDAQ. Okay, the NASDAQ 100, I think. 621 is the NASDAQ. Yeah, 620. We're down 620 on the NASDAQ 100. That's serious. And of course, I just showed you IWM. So what happened was this. It's not what he comes out the chair, and he didn't say he was going to raise rates. He didn't say he's going to change policy. I mean, those are the things that always crush IWM. And he didn't issue a new forecast. So what the hell did he say? He said, oh, I think prices are too high. That's all you have to hear. One sentence. Prices are still too high. And the machines kick in. Now, what are the machines? They're not computers. Machines are a software program designed, okay? It's an automatic trading system, and they put it on the computer. It takes the place of the big institutions, like the hedge funds and so forth, and the insurance company and the biggest banks. When they're not in the market, like right now, they have money in the market, but they're not trading, they're not bringing new money in the market. They usually have 10 to 12 trillion in the market. They only have 1.2 trillion in the market, and they're not using that to buy or sell stocks. What moves the market with them right now is when they're changing their position, but they're not in here with their 10 to 12 trillion. That's very bad. So what happens, there's a program that's written, okay? It's a trading system that's put on the computers so they kick in. And that's not good, having the computers do that, because again, if you have a big rally, let's say you have a big rally one day, all right? Let's say the rally goes up 200, 300 points. And I think I told you this before. Institutions, when they have they're leading a rally at 300 points, they'll support it at 300 points. The machines don't. All of a sudden they'll start selling. So you could lose a quarter of it, a half of it. So you always got to be careful of that. You always got to know what's moving the market. Is the institutions or is the program the machines have, the software moving the market? Because again, same thing. When they drop a stock and you're shorting it, it's going down. And it's down, let's say, 300 points, you know, oh, that's a good short. All of a sudden, it can go right back up and claw back half of it. That's because they don't support their long, they don't support their shorts. But anyways, so today he came out and he said that he thinks, again, that he's assuming, I should say, that the prices are still too high. The machines kicked in with that one sentence. So the machines instantly assume that there's going to be no rate cuts in the future. That's not good. Or fewer at least. And it also assumes the computer tightening financial conditions. That's what happened. As soon as that occurred, yields shot up. Bam, they went up. They hit, I think, 400, the 10-year was at 4.45, and I think it went up to 4.51. That's a huge move. Now, most people don't trade. They don't understand how big of a move. When they hear, well, we went from 4.45 to 4.5, oh, what is that? That's like the length of 100 football fields. That's huge, huge in this business. So the machines took over the market, and what happened is the financials aren't as strong as energy, but the only ones that benefited out of financials, transports, industrials, and energy, IWM, energy is the only one that really benefited, and the banks. So energy, that did the best today. And again, we went long. We were already long a couple of stocks, COP and CVX. So energy rallied, and financials did okay, but all these stocks they're supposed to really rally today. You only had a couple of sectors that are doing well, but that's okay. You only need one or two sectors to make a lot of money. So remember, IWM is the truth serum. Anytime something's wrong, look at IWM. If IWM is going down, that's a big red flag that either a correction is coming or a crash is coming. That's what it means. Now, it doesn't mean it's coming overnight. Not going to mean it's going to be tomorrow or this week. But it just put in the back of your head, it could happen. And the more and just always remember before I leave, IWM in 25 years had never been wrong. Identified the 1972 crash, 2000, 2008, 2018, 2022. That's a pretty good record, don't you think? So always watch IWM and always watch your yields. Okay? Remember, it's real simple when you're trading. There's only two sectors that count. Your defensive stocks and your tech stocks. When yields go up, your tech stocks get hit. And then everybody rotates back into your defensive stocks, like utilities, insurance, that sort of thing. Terrible stocks, hate those stocks. But that's where they rotate to. And then, and if you watch IWM, you watch the defensive stocks, you watch the tech stocks, that's where the whole cycle is right there. The whole cycle. And then there's one other cycle too, of course, is the oils. And I'll talk to you tomorrow about what happens with the oils. Okay? All right, so that's it. I hope this helps you. At least I hope tonight that hit you enough IWM, serious enough that you say, I think I'm going to really look at IWM. That sounds like it's the truth serum. I want to look at that. You'll never be wrong. Between IWM and the yields, you'll always know the direction of the market. Again, last thing, you don't have to ask the question anymore. What do you think the market's going to do? What's the direction going to be? Think of the 10-year yield as a street light. Hits 4.50, tech, which everybody's making a fortune on, collapses. That's simple. And when it goes down below 4.25, then tech does well. That's as simple as it is. And remember, these tech stocks, there's 6 to 12, I'll say 6. There's 6 stocks holding up the whole 700. Okay, I hope you enjoyed this. Thank you for listening to my podcast. Join my gang, Phil's Gang. It's free for 10 days. Check us out, philsgang.com. See you on the charts.